Welcome back to another installment of What Are the Odds? Taking a look at right here, the blue line represents the S&P 500. The red line represents the price of gold over the past several months from June through the beginning of October 2022. And we can see a very strong correlation or relationship between the two markets. When gold goes up, so does the S&P 500. And when stocks go down, so does the price of gold. This is actually a very unusual phenomenon. Under normal market conditions, let's say, for example, under a strong economy, as we expect higher corporate earnings, stocks go higher. The dollar goes higher because traders will sell other currencies like the euro and the British pound and buy the US dollar. And as the dollar goes higher, the price of gold goes lower. Gold tends to move opposite of the US dollar. Gold is a hedge against the dollar. So right now we have a positive correlation. And the reason why this is occurring is because the overall theme is that the Federal Reserve is expected to continue to raise interest rates over time to combat inflation. Well, the expectation of higher interest rates is sending Treasury yields higher, it's sending the dollar higher, and sending stocks lower. Stocks don't like higher interest rates, for sure. So that's what's happening. It's actually kind of an unusual phenomenon. That's why I wanted to take a look at it. On the left-hand side of the chart, the blue line represents the S&P 500. The black line represents the correlation between, the average correlation between the S&P 500 and the price of gold. Currently, we have a near 70% correlation, which is very strong and, again, very unusual. The right-hand side chart, it's the same chart, but this time the yellow line shows us the price of gold. As gold goes lower and the stock market goes lower, the same black line shows us that 70% correlation. Now, trying to consider how often this happens, we see here the frequency over the past 20 years. How many trading days over the past 20 years did we actually see a 70% correlation? Now, we've measured the correlation on many different timescales. So, for example, the light blue line represents a 10-day correlation. Over the past 20 years, how many times did a 10-day correlation produce a 70% relationship? Well, we can see here around 300 some odd days, which is actually a very small number considering 20 years of data. To make things simple, the yellow dotted line represents the average of a 10-day, 20-day correlation all the way up to a 90-day correlation. And we can see here the 70% correlation, which is a current market condition, is actually very unusual. It happened a little over 300 days, but 300 days over the past 20 years is not a lot at all. And we can actually see that any correlation below 50% represents the vast majority of our data. The vast majority over the past 20 years, the frequency of correlations occurs with a less than 50% level. Taking a look at this data from a little bit different point of view, the 70% level over here shows us a 70% correlation, the average correlation. And we can see it's actually a very small slice taking into consideration the entire scheme. So a 70, 80%, 90% correlation, put that together, that may represent only 15% of the past 20 years. In fact, the vast majority of the past 20 years represents either a negative correlation or at best a somewhat neutral correlation, meaning that the current situation, again, is very unusual, where we see a strong relationship between the S&P 500 and the price of gold. Now, what can we deduce from this? How can we expect the markets to perform over the long term? Well, we can see here the blue histogram bars show us the maximum or the best stock market performance over the forward-looking 90 days. What is the most amount of money we could make buying the S&P 500 at any given correlation? Well, over the past 20 years, the S&P 500 tends to produce a 7% return on investment over the next 90 days. Now, this is a maximum return, not the average. The best we could expect to make is 7%. But actually, it's not so good because, first of all, that's the maximum. And in addition to that, stocks tend to go up over the long term. In fact, the average over the past, let's say, 50 years for the S&P 500 is around 7 to 10%. So taking a look at the blue histogram bars, the actual worst performance for the S&P 500 occurs when we have a 50% or better correlation between stocks and gold. The orange lines represent the average, or I should say the best performance for the gold market at any given correlation. And we can see the orange lines are the highest when we have strong correlations. Point being is that under periods of time when we have strong correlations between the S&P 500 and the price of gold, stocks tend to perform the worst and gold tends to perform the best. So now, of course, past performance is not indicative of future results. However, given the data does suggest that number one, this very strong relationship between the S&P 500 and the price of gold, number one, is very unusual. And number two, this type of market climate tends to produce the worst stock market performance and some of the best gold performance over the next 90 days. If you're interested in this type of approach, looking at data and what it suggests for future performance, we've produced several other videos called What Are the Odds? And we'll play the link right here. And if you're interested, please have a look as well. We hope this has been helpful. We look forward to seeing you back soon.